What if I told you there's an investment strategy that has been quietly minting billionaires for the past 15 years, and almost nobody outside of a Manhattan skyscraper even knows it exists? It's not crypto, it's not AI stocks, it's not real estate, it's not anything you've probably heard of on social media. It's something so boring sounding that most people immediately tune out the second they hear the name. But here's what's wild. The people managing your pension fund, your university's endowment, your life insurance premiums, the smartest institutional money on the planet, they have been quietly pouring trillions of dollars into this one strategy, and they've been doing it for over a decade without making a single headline. Today, I'm breaking down exactly what this industry is, how it exploded from $140 billion to $2.5 trillion in less than 20 years, why Wall Street is absolutely obsessed with it, and what the people at the top don't really want you to think too hard about. Let's get into it.
The industry is called private credit. 2 words. Sounds incredibly boring. Represents one of the most significant shifts in American finance since the 2008 financial crisis. Right now, the global private credit market sits at roughly $2.5 trillion. That is larger than the entire economy of Canada. That is larger than every hedge fund in existence put together. And it is an industry that has grown tenfold since 2007. So what actually is it? Here is the simple version. When a mid-sized American company needs a loan, they used to walk into a bank, shake some hands, fill out some paperwork, and walk out with their money. That was the system. It was straightforward, and it worked. Then 2008 happened. Banks collapsed. The government stepped in. Regulators rewrote the entire rulebook for how banks were allowed to operate. Capital requirements went up. Lending standards got dramatically tighter. And suddenly banks did not want to lend to medium-sized businesses anymore because the regulatory headache was not worth it.
These companies found themselves completely stuck. They were too big for a small community bank. They were too small to issue bonds on Wall Street. Traditional financing had basically closed its doors on them. That gap is exactly where private credit stepped in. Private credit firms like Blackstone, Apollo, and Ares Management looked at that gap and saw an opportunity. They said, "We will give you the loan the bank refused to." The catch was higher interest rates, more fees, and stricter terms. But for companies that desperately needed capital to grow or simply survive, it was the only real option available, and they took it.
Now here is where the numbers start getting genuinely remarkable. In the early 2000s, the private credit market was worth about $140 billion globally. It was a niche corner of finance that most people on Wall Street barely paid attention to. Then, the financial crisis happened, and banks pulled back from lending to mid-sized companies almost overnight. By 2010, private credit had grown to $300 billion. By 2015, it crossed $500 billion. By 2020, it had surpassed $1 trillion. Today, we are sitting at $2.5 trillion, and the projections say it keeps climbing. That kind of growth does not happen randomly. It happens when a genuine problem exists in the market and a solution steps in to fill it. The problem was that thousands of American businesses could not access capital from traditional banks. The solution was private credit funds willing to take on that lending risk in exchange for higher returns.
Now here is the part that makes institutional investors genuinely obsessed with this asset class. Over the last 20 years, private credit has delivered average annual returns of around 9.6%. The stock market over that exact same period returned about 10.2%. So stocks technically win by about 0.6% per year. But here is the question that almost nobody asks: at what cost? Because when you invest in stocks, you are signing up for a genuinely unpredictable ride. The market can swing 20, 30, even 40% in a single year. It can drop 15% in a single week because of a Federal Reserve press conference, a geopolitical event, or honestly just pure market panic. Private credit does not do that. Private credit is stable, predictable, consistent.
When a company borrows $200 million at a 10% interest rate, they make their scheduled payments quarter after quarter, year after year. The cash flows are contractual. That predictability is everything to funds that are managing pension money, university endowments, and insurance reserves. These are not traders looking for a 50% return in 6 months. These are institutions that need to reliably generate 7 to 8% annually to pay out retirement benefits to teachers, nurses, firefighters, and government workers across America. Private credit delivers that. Equity-like returns with bond-like stability.
That combination in the investing world is genuinely rare and genuinely valuable.
Fourth is leverage risk. Many private credit funds borrow money themselves to amplify their investment returns. That strategy works beautifully when things are going well. When things turn, the losses compound just as fast as the gains once did. None of this means private credit is a fraud or a scam. It is absolutely not. But it does mean this is a market that has never been truly stress-tested through a severe and prolonged economic downturn, and that is a fact worth sitting with. Here is where I will leave you. Private credit is real. The growth is real. The returns are real. The $2.5 trillion already deployed into this market did not get there by accident. Some of the most sophisticated investors in the world made deliberate and informed decisions to be there. But every major financial innovation in modern history looked like a permanent solution right up until it did not. Mortgage-backed securities looked genius in 2005. CDOs looked genius in 2006. We know how those stories ended.
The question with private credit is not whether it is working right now. It clearly is working right now. The question is whether the foundation underneath it is as solid as the pitch decks and the press releases suggest it is. And the honest answer is that we will not know the full answer to that question until the economic cycle actually turns. What I do know is this. The more that everyday Americans understand how capital actually moves through the financial system, who profits from it, who carries the real risk, and who tends to be left holding the bag when things eventually go wrong, the better equipped all of us are to make sense of the world we are actually living in. That is exactly why I make these videos. If this one gave you something real to think about, subscribe, share it with someone who actually cares about understanding money and how the world works, and leave a comment below telling me what financial topic you want me to dig into next. I will see you in the next one.